I have a special guest joining me today. I've got Austin Vrabel from Connor Clark and Lunn. Austin is a wealth advisor at Connor Clark and Lunn. Today, we're going to be talking about market volatility in retirement. And I think that this topic is especially helpful for a lot of those do-it-yourselfer type individuals that think that they can manage their portfolio while chasing large returns. And so that's why I've invited Austin to join me today. So Austin, thanks for joining us on this podcast. Before we get started, maybe you can introduce yourself.
Yeah, well, thank you so much, Jason, for having me. As you said, my name's Austin, and I work at Connor Clark and Lunn Private Capital. So the firm has been around for about 25 years, and today manages about $18.5 billion for high net worth, families, foundations, and charities. Connor Clark and Lunn Private Capital is part of the parent company, the Financial Group, which is one of Canada's largest independently owned investment management firms. So with a little over 155 billion in client assets. So large firm. In layman's terms, Jason, what I do is I help high net worth families make money through their investments. How's that?
Perfect. Perfect. All right. Well, let's get into this. Let's talk about market volatility in retirement so we can get some people educated on why it's important to work with advisors. And so where do you want to start from here? I'm sure you have a lot of these types of discussions with your clients, Austin. I'm sure you talk about market volatility pre-retirement and in retirement with your family. So where do you want to start?
Yeah, let's jump in. I put together a little presentation. I'm going to share my screen, and I promise this is going to be fun and engaging. So for the viewers, I hope
All
you
right.
enjoy. So here's what I thought I would do. I put together two different portfolios, and I'm going to flip it back to you, Jason, and your audience, and participate along. But which portfolio would you rather have in retirement? So here's the situation I'm going to lay out for you. It's July 31st, 1998, and you've worked hard and you've gathered $1 million in your portfolio. You're looking to withdraw 60K at the beginning of the year annually for 28 years into your retirement. And so here's the situation below with the two different portfolios. They both have the same starting value of $1 million. Portfolio A's annualized rate of return is slightly lower. It's at 6.91% compared to Portfolio B's at 8.96%. And the volatility in Portfolio A is 7.1%, so slightly lower than that of Portfolio B's, which is 14%. And again, withdrawing 60K from your portfolio over 28 years, and you have the luxury of knowing what your outcome is from the two different portfolios. And now you get to pick which one would you rather have. So,
Yeah.
Jason, which one would you?
Well, I've been doing this for a long time, Austin. So I'm going to go with Portfolio A, but I will guarantee you that a lot of people will be looking at Portfolio B and being like, well, this is a 9% return. That's where you should go. Because why would I want to get a 7% return when I can get 9? And I'm betting that's what you would hear a lot. That's what I would hear a lot.
Yeah, exactly. We often find clients look at returns in isolation. So if you're looking to invest for 28 years, of course you want the higher annualized rate of return, Portfolio B. However, when you factor in your withdrawals, that's where this volatility comes into play. So I'm going to scoot down here and show you the results. So here's the portfolio value in the highlighted area after 28 years. And I'll disclose that Portfolio A is the CCNL balanced portfolio. So that's a balanced allocation between equity and fixed income. So you can see it's 55% in equity versus 45% fixed income, and compared to Portfolio B, which is the S&P 500 index in Canadian dollars, which again would be 100% equity. So when I show you this, I mean, people look at us and they, well, what the hell's going on, right? Like,
Mm-hmm.
as you just said, you'd want to pick the portfolio with the higher annualized rate of return, but as a result, you're left with less than half of the portfolio value you could have had in a lower volatility portfolio.
Yeah, totally. Well, that's exactly why I wanted this message to get out there, because most people would pick the 9% portfolio, but that's to their detriment, right? And because they don't understand how market volatility in retirement can actually have a permanent impairment of your capital if you're withdrawing in down years,
Yeah.
and that's the message I'm trying to get out is the value of working with a group like yours and a group like ours, where we can advise our clients on the types of risk that are hitting them right in the face right here.
Well, that's exactly it. And first, I should touch on exactly like kind of what's happening here. So it's something called sequence of return risk. So
Mhm.
when you withdraw for your portfolio, especially during market downturns, it permanently reduces your capital base. So if you think about it logically, right? So if markets go on to recover later, but you had sold down at the lows, you have less money to participate in the rebound. And so a high volatility portfolio accelerates depletion despite potentially having higher average rate of returns, which is exactly what we're seeing. So, for people that try to do this on their own, it's a really tough conversation to have. And it's why people like us exist, because, we're professionals and our firm has been doing this a long time. And it's why people come to you to rely
Totally.
on this advice. And,
Totally.
for a lot of people, I think they only look at that annualized rate of return. And this could cost you potentially half of your market value. So
Well,
this is
that
someone's life savings. And
absolutely. And people are so worried about fees, wondering, "Oh, I'm gonna save money on fees doing it on my own." Well, there is no way that over a 28-year period, your fees would amount to $530,000, right? I mean, in my true opinion here is if, managing your money on your own without having the knowledge and understanding of how markets work is kind of like pulling out your own tooth when you can go to the dentist to do it, right? It makes more sense to go to the dentist to pull out your tooth rather than going to Canadian Tire, buying some pliers and doing it on your own. That's just ridiculous.
yeah, exactly. And I mean, like, they often have the expression in our industry, right? Like, are you able to sleep at night too? And just having that professional person to help mitigate this and take this off your plate. We have a lot of clients that are busy with their careers and they want to spend time with their families. And the last thing they want to be doing is checking their portfolio, and they start freaking out when, as we saw with the April lows and the reciprocal tariffs, things can get a little worrisome, especially if you turn on the news and it's everywhere, right? And so that's what we're here for, to have
Yeah, yeah.
professionals help, and it's what CCNLs does really well is manage that volatility, which really matters in retirement years. So I thought maybe, Jason, I'll just flip ahead to the actual data
Yeah.
here to kind of walk through a couple lines. So as you can see on the right hand side, 98 was a strong year. This is heading into the dot-com bubble, right? 30% rate of return. Wow, like what a year. Followed by a 99, almost a 20% rate of return. And if you compare that to portfolio A of a 7.5% rate of return, drastically underperforming in that year, and then to go on in 99 and only get a 3% rate of return, that would be a tough place to be in, especially if you have someone that is in portfolio B and they're doing it on their own. And
Totally.
why am I paying for this? Or so if I had just disclosed to you those two top lines, I think everybody would go after portfolio B.
Yeah, well, you're not wrong. You've got individual in portfolio A, but they're enjoying a barbecue with their buddy who's in portfolio B, and their buddy is like, "Yeah, I just got a 30% return." And the guy in portfolio A is like, "Well, my advisor says to stay the course because volatility matters in retirement, so I'm going to do that." And then they get 3% the next year, and they're out enjoying the barbecue again with their friend who says, "Yeah, not only did I get 30% last year, but I got 20% this year." So then, I'm sure you see this all the time where then it's not long until the other person says, "Well, why am I in portfolio A? I should be chasing returns in portfolio B because I'm going to be able to increase my lifestyle in my retirement." And so they do that. And that is to their detriment, right? They're just not willing to understand and take the advice of their advisors. And I think that that's a huge problem.
Well, Jason, you said they were out there enjoying the barbecue, and I don't know about you, but I wouldn't be enjoying it if I knew that I was, you know,
Yeah.
drastically underperforming for 2 years. It's a bad feeling. I mean, we've all been there, and I think we can all
Yeah.
relate. So, I do want to preface that I did another scenario where instead of withdrawing from the portfolio over the 20 years, this is a set and forget, $1 million starting value. You don't touch it. Let's check out what the ending values are. You could see that portfolio A is 6.4 million, which is still a sizable amount, right?
Mhm.
After $1 million investment, but portfolio B is far ahead. It's at $11 million. So what this is all kind of coming together and saying is that volatility matters all the time, but it also I would say it matters more in your retirement years when you're
Mhm.
withdrawing from your portfolio, and that's what I touched on earlier, is that sequence of return risk.
Yeah, yeah, absolutely. Well, that's a great message, and I really appreciate you taking the time to meet with me and the audience today to educate us a little bit on the sequence of returns risk. So, understanding what market volatility can do to you, unfortunately, in retirement, and yeah, I hope that everyone got a good understanding of this. And so, if you want to reach out to Austin, I'll put his contact details in the comment section below, and you can reach out to me at 360 Wealth. .ca. We work with business owners that are within 5 to 10 years of selling their business or they recently have sold. We appreciate your time. And Austin, once again, thank you for joining us.